So hello, afternoon all. So I've been in the private equity team at Aberdeen for just over 13 years now, and I've been the lead portfolio manager on the Aberdeen Private Equity Opportunities Trust since 2019, the trust formerly known as Standard Life Private Equity. So why don't I quickly take you through this? I'll assume you have little to no knowledge of the trust. Apologies if some of you do know it reasonably well. I'll be covering some ground, but yeah, as Nick said, please feel free to type in any questions in the box, or we can speak at the end as well. So if we move to the first slide, some of the key highlights here. I mean, at the most basic level, this trust is about providing investors, retail investors, wealth managers, smaller institutions with access to private equity, which is an asset class that's been dominated by institutional investors for some time, and they've benefited from the strong returns and the diversification benefits. This trust was launched in 2001, so over 2 decades ago now, to help broaden that I guess the access to the asset class, really enable investors to get private equity exposure for the price of a share. So we provide access to private equity through funds, private equity funds, either committed to at the point, at day one, completely blind pool. So that's around diligencing managers and understanding who the best managers are in Europe and being able to access them. Or it's through acquiring funds part of the way through their lives from other investors. So that's sort of the funds part is one area, and the second part, which is newer, and we started to do in 2019 in the trust, is co-investments, which is essentially direct investments into private companies alongside the lead private equity sponsor. And the beauty of co-investments, which we'll go into in a bit more detail, is that they cut out a layer of fees, and so that should be beneficial to investors, assuming we get our selection right, and signs are promising there. So as I mentioned, launched over 2 decades ago. It's on the FTSE 250, over 1.15 billion in net assets. And we're really focused on Europe here, and we're really focused on the mid-market segment of private equity. And we'll come to the reason why we think that's a particularly attractive place to play. Last is in terms of second from last, I would mention that this pays a dividend on a quarterly basis, which equates to at the moment around a yield of 3.5%, and the dividend was increased by over 11% in the last 12 months. And lastly, in terms of returns, this has delivered an annualized NAV total return of 11.4% since inception to the 31st of December 2022. So we move over a slide. The next slide is really outlining how, again, it's sort of underlining how we invest in the private equity market. So APO, as we call it, as we call the trust, basically partners with some of the leading private equity funds, principally in Europe, and we do that through the funds themselves and the co-investment. So our 12 core managers represents around 57% of the portfolio, and the logos are there on the sort of left-hand side, top left side. Now, through co-investments and through the funds themselves, essentially provides underlying exposure to some of the leading private equity-backed companies in the market. And we have over 650 companies in the trust. And then the exposure by sector, you can see on the right-hand side, pretty well balanced. Healthcare and technology are the largest sort of single exposures. Healthcare just slightly ahead, just shy of 21%. And then pretty well balanced thereafter. So consumer staples at 12%, consumer discretionary as well, quite high. Industrials, which includes B2B services, and then also financials as well. We have very little in energy, which has been unfortunate in the last 12 months. But we tend to find that private equity-backed strategies linked to commodity pricing over the long run tends to be a bit more volatile than we tend to like. So that's why. So that's how the trust invests. So maybe we turn over a slide and talk a little bit about the the manager itself. So we have presence in North America, in office in Boston, but principally in Europe through offices in Edinburgh and London. We have just shy of 40 investment professionals across those offices. We have just shy of 10 billion euros AUM in Europe. And we've been investing in private equity really since the 1990s. And we have had investing relationships with over 300 European managers in the space. And we've actually managed over 1,000 private equity fund commitments over that time. So we feel like that long presence, the network and experience, it sort of gives us a point of difference in the marketplace. And if we turn over the next slide, sort of gives you a sort of view of the senior team. So obviously I'm the lead portfolio manager here, but it is very much a team effort. The whole team is incumbent upon the whole team to source interesting opportunities for the trust, whether it's funds or co-investments. So I obviously lead that, but Martin Nicholson and Patrick Connectley, who are the head of primary investments and secondary investments, support me and are also key executives on the trust. But it is a broad senior team with over 20 years of experience on average. If we move over to the strategy itself and delve into some of the points I mentioned at the outset, so a couple of slides time. So it's just reiterating the point around access. So fundamentally, APO is about providing private equity opportunities to all types of investors and giving access to the best managers that are often oversubscribed, that are difficult to access. Some of the circles on the right-hand side sort of underline the challenges, which you'll be well aware of, but you know, there are over 3,000 private equity firms in Europe, according to Preqin. So, you know, we back 12 core private equity firms. So it's about filtering out, you know, the opportunities that are lower conviction, maybe not as high quality, and really narrowing in on those that we really believe are best of breed. The size element of it as well in private equity is important. Typically, private equity funds have a minimum investment amount of between 5 and 20 million euros per fund, which can make it quite difficult for certain investors. From a regulatory point of view, it's quite hard and a complex environment. Liquidity is a key thing as well. You know, daily liquidity is not available unless invested in a listed investment trust such as APO. It's generally just quite a complex environment where the sort of best names are hard to access. And if we move over the slide around APO, so it's been around for a long time. So I would emphasize the consistency in terms of NAV growth here. The NAV has grown year on year since 2010. It's grown, I think, pretty much most years in the trust life. I think sort of the exception being between 08 and 10. And as I mentioned, the annualized NAV total return since its launch is 11.4%. So that's the light blue line there in terms of the NAV per share growth. You can see the share price, the other bubble, sort of darker blue bubble there. The discount narrows and widens quite materially. You can see that following the global financial crisis. Prior to the global financial crisis, the share price and the NAV tracked very, very closely. But since then, most private equity trusts have traded at a discount. And you can see right now on the far right-hand side, the discount is as wide as it's really ever been. We think that's unjustified. We think it provides an opportunity for investors that are long-term minded. And we can talk a bit more about that as we progress through the slide deck. Over the slide, just want to re-emphasize the focus point. Now, we already talked a little bit about this, but the private equity market is very, very large. Over 15,000 managers globally, over 3,000, as I mentioned, in Europe. And we're really looking to filter down to around the 12 best, we believe. On the right-hand side of this, again, is emphasizing how, You've got the large private markets universe that includes real assets and infrastructure, credit, things like that. Private credit, should say. Then private equity, which again includes things like venture capital, growth equity, large private equity, buyouts, which is very much about profitable businesses, cash generative businesses being majority owned by a private equity firm. That's where we focus. We can talk a little bit more why that, from a risk adjusted point of view, we think that's attractive. Over the slide, we think having this conviction-led, that focused strategy leads to better returns. So on the right-hand side, on the left-hand side, sorry, again, it's emphasizing this 57% of portfolio NAV to our 12 core managers and our top 10 investments representing around a third of the portfolio. We're not a private equity index. We're not trying to back many things. We're trying to partner with a small subset of the universe. On the right-hand side, you can see how that translates to returns. So you can see that over, both since inception and over the last 10 years, over 70% of our fund picks have fallen in the second or top quartile. And we think that to get differentiated returns from private equity, you have to back the top and second quartile performing managers, differentiated returns relative to public equities. And we can show that we're doing that. On to the next slide. Is just some of the activity over recent years. Quite a busy slide in terms of logos, but there's a few things I would pull out here. Firstly, the top half of this slide is the logos of the managers that we backed from a fund perspective. Key things to pull out here is we're backing more sector specialists. So we think the next 10 years of private equity would be defined about knowing very deeply certain subsectors in the marketplace. That will differentiate you when it comes to winning deals. That will differentiate you in terms of creating value at the business level. It'll also differentiate you upon exit because you will know the trade buyers that you regularly sell to, the trade buyers that are willing to pay a premium in terms of price. So that's why you see logos such as HG, which you'll know very well, I'm sure, and some of you may be shareholders there. We fundamentally believe they're the best software specialists in Europe in terms of what they do. But there are others in technology space that we back. So OnePeak from a growthier perspective than HG, Permira, who are a little bit larger generally than HG, a Great Hill as well that are more US focused. So those are sort of technology specialists that we've backed. Equally in healthcare, we've backed the likes of Archimed, who we think are the equivalent of HG in healthcare. A lot of former healthcare company CEOs, operators that are directly involved there. But there are others like Nordic Capital, XLR, Windrose that are similar. And then if you look at other sectors as well, American Industrial Partners and Triton in industrials, in manufacturing businesses, Seidler in consumer as well. So that's how we're investing. We're generally investing in mid-market and actually lower mid-market firms now because we feel the competition is less institutionalized. There's been less capital raised there in private equity relative to the large and mega cap end of the market that's seen a lot of capital coming in over the last 5 years or so. And in the bottom half is co-investments and secondaries, or the sort of more opportunistic strategies as we call them. Thing that I would pull out, and we'll talk a little bit more about co-investments later in the deck, but just the real momentum in this space. We've gone from having no co-investments in 2019 to having 24 at last count, and we're about to announce the 25th as well. So real momentum there, and we're backing our winners for longer as well. You can see follow-on investments in the most recent year in European Camping Group and Funicap, two businesses that are performing ahead of plan so far. But we'll talk a little bit more about co-investments a bit later on. And then the next slide sort of emphasizes our European focus. We really like Europe for a number of reasons, but we feel like with Europe, it's just because it's heterogeneous relative to the United States, there's just a lot more complexity in terms of doing private equity deals. So different languages, different cultures, different regulation, legislation that you have to navigate. And it becomes really, really hard for a private equity firm to do that by flying in and out from the United States or from Asia. You need to have feet on the ground, especially in certain sort of more closed markets, such as, for example, France, where frankly, if you're not French, if you're not, you know, in the Paris market or the Lyon market, you're a step behind. It's going to be very, very hard to win deals effectively against the local players. So what that means overall is we feel that there are certain barriers to entry, and backing the incumbents, backing those that are on the ground, the best of breed in Europe becomes more and more important. And you know, we have that long track record in doing exactly that. Over the slide. So I mentioned Europe, but mid-market as well. So that's where we focus, sort of lower mid-market and mid-market segment, essentially companies between an EV of 100 million euros to €1 billion. That's our core focus. We don't do any venture capital. That's been a very successful you know, part of the asset class for a long, long time. But from our perspective, there's less, well, it's more about partnering with the strong winners in venture capital. I think there was a stat, it may be slightly out of date now, but that around over 80% of returns in venture capital are generated by 10% of the managers. And sort of accessing those managers at all costs becomes really important in terms of generating returns. It can also take time for liquidity to come through in venture, and there's perhaps less chance to partner with managers from a co-investment point of view. Also, venture capital is probably the key space, that and growth equity, where valuations have become under quite a lot of scrutiny over the last 12 months. A lot of managers are valuing on last funding round. So we feel like not having exposure there right now is no bad thing. But I'm sure over the next 10 years, venture will do very well. I just think that the last few years, it's been kind of unprecedented and unlikely to be repeated. Growth equity will do a little bit in that space. Companies that are approaching break even, it's around 5% of our portfolio at the moment. We'll be very selective around that, but you know, that's an area that we're alive to. But it's really about backing profitable cash generative businesses in that mid-market space that are majority owned by private equity, where the private equity firm can really add value and be hands-on. And that's what we've done in this trust for over 2 decades. Lastly, I mentioned the large cap space. We have shied away from that space because if you look at the fundraising charts, and I'm very happy to provide those afterwards, you know, a disproportionate amount of capital has been raised by the very big guys in private equity. There are obviously less targets in this space in terms of companies. Management teams are very institutional. It becomes a little bit more about capital structuring, you know, some would say financial engineering. It's a little bit more about that than true value creation. And I think the large cap will continue to do well and has done very well over the last decade with low interest rates. But we like being in that mid-market where companies are not the finished article, where there's the ability to take a product into new markets, where there's an ability to increase the sort of product set. There's ability to scale through buy and build, or digitize the business, or you know, improve its sustainability credentials. There's usually a lot that private equity can do there to accelerate earnings. So you know, that's why we focus in on that space. And then over the slide is emphasizing the relationships here. So we do drop managers from time to time. That's why the core managers are not 100% of the book. We do bring new managers in. But the vast majority of our core managers we have known for a very long time. And it's very, very hard to know what's happening inside any firm. But having that long-term relationship, understanding, are they keeping their promises? Are they doing what they said they would do? And knowing the people very, very well, you know, that's very important in terms of what we do. And that, I think, helps us underwrite these managers from a primary perspective. When you're investing in a fund, and you're putting away capital for 10 years, it's very, very important that you know what's happening under the skin of it. So, so we feel like we do that in APO. Just to maybe talk a little bit about the portfolio over the slides. We've talked a little bit about sector, and it's pretty well balanced with healthcare and technology at the forefront. Europe, we've talked a little bit about. We're largely Northwestern Europe focused, very little in Southern Europe. We've got around 23% in North America, mainly through managers, European managers that have expanded into North America. Important thing I would pull out here is on the right-hand side, the maturity exposure. We don't try to market time in private equity. It's the cliche, but we think it's true that money tends to flow into private equity at the wrong time, i.e. at the height of the market. People get, you know, seduced by the high returns they're seeing like being made, but then they very quickly sell out of private equity when the market turns. And, you know, it was one of the first things to sell. We try and stay in the market and invest consistently across the sort of vintage years. The reason for that is that private equity has shown time and time again that in times of uncertainty and following crisis situations, it makes many of its best investments. So we think it's best to keep committing. We try and do that and stay balanced. Around or just under 50% of the portfolio has been held now for 4 years or more. So we think that underpins good cash coming back to the trust over the next couple of years as well. So there are many reasons why we try and consistently deploy, but I think capturing the best investments throughout the cycle is the key thing. Responsible investment is important to what we do. You know, we are a PRI signatory, and this is over the slide. We're a PRI signatory, have been since 2007, but really we only started integrating ESG around 2015. We received the top rating from the PRI in their latest assessment for indirect private equity, which we're really pleased about. So it's very much embedded in our process, and you'll see our first TCFD report, which is the sort of regulation in the UK. We'll release a TCFD report in a couple of months' time, the first one for the trust. So a lot more information held within that. Co-investment and our kind of evolving portfolio over the slide is the next thing I wanted to touch on. So we've been co-investing alongside our managers for a long, long time across all mandates. But for whatever reason in the trust, it was always seen as a fund of fun. And when I got involved with APO, I thought this kind of didn't make sense because there's a lot of benefits from co-investment, not least stripping out a layer of fees, but also giving you more control over your portfolio construction, what subsectors you want to target, giving you more control over cash, all of those good things. So we introduced co-investments and got board and shareholder approval to do so at the start of 2019. So we went from basically no co-investments to co-investments being 21% of the portfolio at last count across 24 companies. We're aiming to get to around 25–30% in the short to medium term across 30 companies roughly. And then we'll make a call from there. If you get the co-investors right, if you build that big diversified portfolio, then they should be accretive to returns. And it's worth pointing out that we have a flat fee here. We don't have a performance fee, unlike most private equity trusts. So the benefits of co-investments in terms of returns will flow through to investors. Over the page has the table of co-investments. Obviously there's 24 or so in there. Don't intend to go through line by line, but a few things I would stress is it's still a young portfolio. The vast majority of companies are either ahead of plan or performing in line with plan. The average age of the portfolio is around 2 years, and we saw very strong valuation growth in the last financial year of over 50%. Some of the names there that you may recognize. So Action is obviously the main investment or the main company in the 3i Trust. So we invested in Action through APO back in 2011 through 3i's fifth fund. And then we co-invested alongside 3i in January 20. So that business is a non-food discount retailer, basically sells like a broad range of items from gym equipment to gardening equipment and basically non-perishable items across a number of categories. A lot of the offers are one time, so that creates a strong following from customers who go in, week out to see what the latest offers are, see what bargains they can find. And this business has really grown exceptionally strongly. It's sort of started in the Netherlands, moved into France. It's now across 10 countries, over 2,000 stores, and they think they've got white space to 5,000 stores across continental Europe. So a phenomenal business, performing very well. We've taken some money off the table here, took a partial realization through the process that 3i facilitated, which allowed a liquidity offering. So we basically took around our original cost off the table, but Action is our largest underlying portfolio company. It's just shy of what's around 4.5% of the portfolio. Also, ones you'll recognize, Visma, the cloud-based ERP software business, and HG being the lead sponsor there, performing very well. NAMSA is one you're probably not familiar with, which is a contract research organization for the medical device sector. So large medical device manufacturers are typically outsourcing the testing part of their new product design, and NAMSA is one of the companies that they outsource to. That's ahead of plan and performing very well. And that's one actually that we may see an exit over the next 12 months. We've also got things like Funicap, funeral services business, very resilient, unfortunately for all of us. And that's just done a big acquisition in Italy. It's based in France and sort of starting to roll up inorganically across other countries in Europe. So we're excited about that one in a strange sense. If we move over the slide, some others I'd pick out. We've actually got a case study on ACT, which is fourth from bottom there, which does sort of climate services for corporates, mid-size and large corporates. So really allowing them to offset their carbon emissions, which is quite relevant, obviously, in this market. European Camping Group, which is around the middle there, sort of does what it says in the tin, but it's got basically luxury, and regular campsites across France, Italy, Spain, and Croatia, and it's just undertaken a transformative acquisition of one of its peers, Vacans Select, which has increased the scale of the business enormously. This was our bet around, not so much a bet, but our investment around the recovery in travel and leisure post-COVID, and it's performing very well, both organically and inorganically. Other things, I mean, you may recognize Sport Pursuit. Some of you may be customers of Sport Pursuit. It basically offers discounted branded sportswear behind a membership wall. So brands really like this concept because you can't go onto Google and find a pair of Adidas trainers at 50% discount because of the membership wall. But Sport Pursuit can help these retailers clear their excess inventory in a way that's a bit more discreet and doesn't impact the perception of their brand. That's just undertaken a large transformative acquisition of its peer in France, Private Sports Shop. So that'll have a lot of synergies and scale benefits there as well. So bottom line is the co-investment portfolio is performing very well. Still early days. Knock on wood, we feel really, really good about it, and should be accretive to returns. If we move on to sort of latest performance, talking about returns. So this is for the 6 months to March. A couple of things to pull out here. Whilst it's the 6 months to March, we don't have the March valuations yet. They're just coming in now. So there's only been one revaluation of the portfolio during this period. That revaluation resulted in portfolio growth of 2.3%, but the strengthening of sterling relative, particularly to the dollar and euro, following sort of the reversal of the losses seen during the Liz Truss's premiership of in the UK has been a material headwind during the period. So we're actually exactly 0.0% in terms of NAV total return. But so far, I mean, in terms of March numbers coming in, the one that I can mention is Action, because 3i have announced it, and that has seen Action increase in value by 10% over the quarter, or roughly around 10%. So that's not yet in our numbers. So that'll be coming through as we announce our March numbers. So positive sign there. And generally, the mood music around private equity is that the market will be up when the March numbers are fully fed through. Unsurprising, given that broader markets were up during the period as well. Slight increase in share price total return. That's based on the share price you can see below, and 412. Share price is around, I think it's around 450, that mark at the moment. So it's increased since then as well. And in terms of the bottom right there, the expense ratio, we have a pretty consistent expense ratio around 1.1%, given we have a flat management fee. So it's pretty stable around that mark. But in terms of the NAV performance, it's worth putting it into context. We saw a slide earlier, which had the sort of NAV performance since inception. Over the slide, we've got the performance since 2010, which is admittedly a little bit convenient for us post-global financial crisis, but does show consistent growth over the long term. So last year we're very pleased with that performance of 14.1%, albeit a little bit of an FX tailwind with the sort of depreciation of sterling. But the portfolio grew over 10% last year in constant currency. And then 2021 was an exceptional year, record year, obviously post-COVID and low interest rates and various stimulus in the market sort of helping returns and generating a lot of IPOs from our portfolio. But I think the key takeaway here is that this tends to grow consistently in terms of NAV and over the long term as well. In terms of cash flows over the slide, so we're still seeing a good amount of distributions coming in. I think that many of you will be aware that when private equity exits, or when private equity has exited a business over the last 10 years or so, it has been at an uplift. Over 70% of private equity exits over the last 10 years, according to Bain & Co., have been at an uplift to the valuation only 1 quarter prior. We find on average the uplift compared to the valuation 2 quarters prior is around 25 to 30% over the long run. We've seen notable exits in the period, a lot of them to trade buyers. So if you look at Binding Site, that was sold to Thermo Fisher for sort of a valuation around 30 times earnings. So a fantastic exit for Nordic Capital, resulted in over 3 times our money being returned. And then Transporeon there with HG, that was sold to Trimble, the US trade player there, a significant uplifting over 20%. Overall, the exits realized in the period in the trust have been at 16% uplift. So there's a lot of talk about private equity valuations, but we've still seen, admittedly with a lower exit count, we're still seeing an uplift in our book when assets have been exited over the last 6 months. So really pleasing in that regard. In terms of balance sheet over the slide, so the key thing during the last 6 months, or certainly over the financial year so far, has been that we've increased our revolving credit facility from 200 million to 300 million to give us a bit more firepower and a bit more downside protection. So we're really pleased about that. And we have a last count around 230 million or over 230 million of liquid resources, i.e. cash and undrawn revolving credit facility. We do run an overcommitment strategy, given that we invest in funds, but we feel very comfortable with the outstanding commitments at the moment. So they sit at just over 680 million. So that's funds that we've committed to that have not yet drawn their full amount. But we think around 80 million of that is unlikely to be drawn, and it's at the lower end of our overcommitment ratio. range. We typically like to have our over commitment ratio between 30 and 75%, but really it's between 30 and 50%, and we're at 37% at the end of March. So so we feel like we're in a good place, and there's certainly a lot of capacity, you know, at the trust at the moment. I have some case studies. We can very quickly go through them just to give you a bit more of a flavor. I mentioned ACT a little bit earlier. So what ACT does, ACT even, so it basically acts like a specialist intermediary in particularly the environmental certification market. So basically advises corporates in terms of meeting their climate responsibilities. So it might be for corporates that are required for regulatory reasons to meet some sort of climate targets, maybe in the aviation sector, for example. So ACT helps these businesses meet those targets. But it can also be corporates that are doing it for voluntary reasons to prove their carbon neutrality. This is a business that is truly global. So it's headquartered in the Netherlands, but really it sells across Europe, US, and China. We're really excited about investing alongside Bridgepoint, the main financial investor here, and management, because we feel like, well, first of all, it's a very fast-growing market. This is a market leader, and we think there's an opportunity to develop its product set and also scale through M&A as well, through buying peers and adjacent or businesses in adjacent sectors. So a lot still to be done here. It's trading ahead of plan, and one that we're really excited about. It's still young though. It's still, you know, a couple of years old, but you know, so far so good there. On to the next slide, Invest Industrial Growth. So this is a manager, this is a fund that we backed. Invest Industrial we've known for well, it was on an earlier slide, but it's around 2 decades, and we invested with them across a number of mandates since before the financial crisis anyway. And here they have a sort of lower mid-market offering. And what we really like about Invest Industrial is that they are very much a market leader in Southern Europe. So it's Invest Industrials was founded by the Bonomi family that are quite well renowned in sort of in industrial circles in northern Italy. So it started as their kind of family office and has grown from there. And they've got really strong focus in industrials, as you'd expect, given the name, given the background, but healthcare, consumer, and more recently in technology as well. But this gives us really an institutional manager that is you know, approaching the Southern European market, which you know, can be a bit looser than Northern Europe. And we really like it because it's focused on businesses below 250 million EV. Again, sort of where private equity competition is less institutional, where there's a lot of value to create. So we're really excited about that one. And then lastly, on the secondary front, you know, when we're buying fund interests part of the way through their life from other investors, it's worth bringing out Project Ivy that we completed last year. So this is one where there was a seller of a large private markets book, actually, not just private equity. It was a real eclectic mix of investments, and they'd come to market. And we saw that within this portfolio, there are 3 funds managed by 3 of our core managers. And we knew these core managers were very, very picky about who they transfer their funds to. Some managers are pretty, you know, relaxed about it and will transfer to well, not almost anyone, but to many different parties. But these 3 we knew were quite restrictive. So we were able to carve out those 3 interests, and actually we'd just done diligence on Altor and Vitruvian, literally done primary diligence last year on them. So we had really strong insight into the funds themselves. And American Industrial Partners we'd committed to 2 years prior as well. So, you know, our knowledge of these managers is very, very strong and deep. and we're able to pick up this cohort of 3 funds for a discount of around 10% to NAV. So you know, really good pricing on the way in, and that started very well indeed. So very pleased with that one. So yeah, just to wrap things up, just in summary, so yeah, it's just reiterating the points. It's about providing access to private equity, you know, focused sort of approach in terms of you know, backing what we believe are the 12 best managers in the European market. It's the expertise in Europe and mid-market over 2 decades, and the consistency in NAV growth.